This is Brian Rezny, president of Rezny Wealth Management and host of the Rezny Wealth Report. We have an incredible show for you this morning, and as always, go to ReznyWealth.com, check out our website, download any of our groundbreaking reports. And if you have questions for today's program, send those to Brian Rezny at ReznyWealth.com. We love questions. We like keeping you on track. One of the things I like to start every show with is just a little discussion about the general economy. You know, the U.S. economy is actually doing quite well. We've had a little bit of volatility as of late in the overall markets, but generally speaking, the U.S. economy has been very resilient. I'm glad to say that our advice, not only on my TV radio show, but how we manage money for our hundreds of clients at Rezny Wealth Management, has ultimately been spot on. We've had no recession in the last 3 years, but recessions have been called for repeatedly by the Wall Street firms, banks, and insurance companies. And again, from our research, we never saw that. We saw a growing economy, high inflation that is ultimately starting to abate, which is good. We're still seeing growth of the U.S. economy on the GDP side, which again is good. Now, while the growth has slowed a little bit in recent months or quarters, we are still growing in the U.S. economy. If I look at the rest of the world, which, by the way, we are not invested outside the U.S. currently at our firm, and there's one reason why. There's very little to no growth in most countries outside the U.S. So if we're going to invest our clients' money, their hard-earned money, we want to do proper research and be invested in areas of the economy that truly have opportunity for the risk we're taking. So we have to look at a top-down approach, which is the U.S. economy first. So for your portfolio, if you're a client of our firm, you would not have international investments right now in Europe because they've been lousy investments, not only in the last decade, but really the last 2 decades. What about emerging markets? They haven't fared much well either. So as a money manager, that's what we do every day is daily research and making sure our clients' money is placed, giving them the best opportunity for return on their money and return of their money. One of the topics I want to discuss today is about really a lot of different scams that are happening, bad advice, and you, the retiree, pre-retire, be taken advantage of. Let's talk about number one. Government impersonation scams. This seems to be a hot topic in the last year or two, and it seems to be getting worse as of late. Scammers pretend to be the IRS, Social Security Administration, or Medicare. They claim unpaid taxes by you. They threaten to arrest or deport you if immediate payment is not made. Folks, the IRS is not calling your phone. They're not sending you emails. They will start with a letter in the mailbox, and at that point, it's going to instruct you what to do. There are a lot of scams today. Government scams are just one of those scams. You need to protect your money and make sure you're not taken advantage of. The other big scam or fraud we're starting to see even more so is on cryptocurrency or Bitcoin. Remember, Bitcoin's a cryptocurrency. There's other cryptocurrencies out there other than Bitcoin. But what we're starting to see is more and more fraud around Bitcoin or cryptocurrency. First off, cryptocurrency is a Ponzi scheme, in our opinion. It is not an investment. It's not an inflation hedge. It's a speculation investment that can go from here to zero overnight. If you are invested or think you're invested in cryptocurrency or Bitcoin, you're a speculator. You might as well buy a lotto ticket. We call it the greater fool theory. The greater fool theory works until there's no fools left to buy cryptocurrency, then the price collapses. I've been managing money over 30 years. I've seen all kinds of fraud, scams, and fake investments. Cryptocurrency, in our opinion, is just the latest. Cryptocurrency scams have surged over 900 million in 21 to over 2.5 billion in 23, an alarming 183% increase. So again, scammers are out there. The fraud is out there. The chance of you actually buying cryptocurrency is probably slim to none. But again, it's not an investment. It's ultimately a Ponzi scheme promising quick riches or exclusive opportunity. It's not going to happen. Protect your money away from bad advice. Adam in Florida, I'm trying to find out if Empower is a fee-only fiduciary. It's all confusing. Adam, that's a great question. First off, the term fiduciary is thrown around by every firm today. Most firms, and we estimate most firms, over 90%, are not fee-only fiduciaries. Most firms are fee-based, so they make other revenues, commissions, product sales, other revenues other than what you're paying them. If they make any other outside revenues, or their advisors or affiliates make any money other than the fee that you're paying them, they would not be fee-only. The firm you cite is not a fee-only fiduciary per their own disclosure. And that's available on their own website. You can read their CRS form and their ADV disclosure form. Here are some excerpts from their own CRS form. Proprietary products. Our affiliates will earn fees, compensation, and other benefits. That's not fee-only. Third-party payments. Our affiliates receive payments from third-party product sponsors. Again, that's not fee-only. Revenue sharing. Certain managers and sponsors or their affiliates share revenues they earn with our affiliates. Again, that's not fee-only. We have other financial affiliations and introduce conflicts of interest to the extent they are endorsements or recommendations for affiliate product or services. Again, that is not fee-only. What I would say is this. In general, if you're working with any firm, general rules or red flags you want to be aware of that the firm that you're utilizing or thinking about hiring is not fee-only. These are the red flags to look for. They use the term fiduciary office, or they say they're fee-based. That is not fee-only. There's a lot of these charlatans out there that you'll go into their office. They're really annuity sales organizations, but they'll say, we're a fiduciary office. That's your big alarm bell, red flag, that they are not a fee-only firm. If they have any outside business activity or sales commissions at all, they might own an outside company that sells annuities and insurance products. That's not fee-only. So what they do is they'll claim fiduciary status on one part, but then backdoor you to try to sell you commission annuities or insurance products. That firm is not fee-only. They are really trying to take advantage of you, the investor. Revenues from product sales. That's not fee-only. That's a big red flag. If they get any sales incentives, revenue sharing, that again is a red flag and not fee-only. If they sell any insurance products, annuities, or life insurance for commission, again, that is not fee-only. They are affiliated with a brokerage house, an insurance company, bank, or they sell proprietary product sales. Again, that is not fee-only. If you go to any brokerage house, the big Wall Street style firms, or the small ones, you go to any bank, you go to any insurance company, none of these firms are fee-only fiduciary money managers. They might do fee-based work, so sometimes they're fiduciary, but then there's other times they're not fiduciary, meaning they don't legally work in your best interest. They can talk a big game, or they can have some great advertising about they look out for the client. The only way to ensure yourself that you're working with a fee-only fiduciary money manager, you need to get it in writing. Have them on their own letterhead write, we are a fee-only fiduciary money manager. We only make money from the fees we charge you. We have no compensation from any other outside company, product, commissions, or any other source of revenue at all other than what you pay us to manage your money properly. Get it in writing on their letterhead, and you can ultimately protect your money. What I would say is this. The landscape, again, is littered with people or firms that say they're a fiduciary. Everybody can call themselves a fiduciary, but a fee-only fiduciary money manager is ultimately what you want. You need to protect your wealth. You have one retirement, you worked hard for your money. You don't want to fret your money away by getting bad advice from a firm that has blatant conflicts of interest and added cost structure above and beyond the management fee that you're paying them, because that, again, comes against your hard-earned dollars. Ask the right questions. You can always go to ReznyWealth.com and you can download for free our report on Real Advisor, Fake Advisor. It really ultimately is a must-read for any investor. Go to ReznyWealth.com. I'm going to take a quick break. When I come back, we're going to take your questions and answer them and make sure you get the right information you need to make proper investment choices. I've just released a groundbreaking report, the 3 biggest risks you must avoid now. If you're a retiree, pre-retiree, have at least $500,000, this is a must-read report. I've covered the risks to your financial security and the facts you need to know to protect your hard-earned retirement savings. If you're at all questioning the advice you're receiving or your portfolio is lacking returns, go to ReznyWealth.com and download your free copy. I hope you're enjoying today's program, and as always, send your questions to Brian Rezny at ReznyWealth.com. One of the things I want to talk about is fraudulent investment seminars, and I'm going to use the term fraudulent investment seminars. The vast majority of seminars are trying to pitch some product. Scammers and organizations put on these seminars promise attendees exclusive insight into lucrative opportunities. However, many of these events are often served really as a front to sell overpriced, worthless investments. Be cautious if you ever attend any seminar. The ones that really are the red flag seminars are when you go to the free steak dinner seminars, because I will guarantee you those firms are definitely not fee-only fiduciary firms, and ultimately they're going to try to sell you some kind of annuity or insurance product in the back door. They may claim at that free steak dinner they're a fiduciary office, but they're never going to say they're a fee-only fiduciary money manager. As always, get it in writing. Protect your money. Be skeptical of high returns. If an investment promises unrealistic high returns, free money bonuses, extra income if you basically keep it in a little bit longer, exercise caution. Remember the adage, if it sounds too good to be true, it is too good to be true. So what I would say is this: if somebody pitches you a product and tells you, hey, if you put $500,000 in this product, we're going to give you 10% free money, that is a red flag. This is typically annuity sales 101. And what it is you're never going to get any free money bonus. No annuity gives you free money bonuses on your actual money that you can immediately take out and spend for retirement or go on a family trip, as an example. What they do is, it's a smoke and mirrors to put it in the fake pot of money. Your real money never gets the bonus, and the only way to take the fake bonus out is to annuitize that annuity at a substandard rate. So again, there's no free money bonuses on any product. How could a company just give you free money? Again, red flag, watch out. Charlatans are after your money, and you need to protect yourself. Gerard in Naples, Florida. Trimming a stock that has performed well. Don't you rid individual stocks you bought at the cheapest price, first in, first out. This gives you the best yield. Not necessarily. So if you're trying to trim a portfolio, what you want to do is really look at taxation. So you may actually trim early positions. You might trim a position that you bought recently. I'll give you an example. You bought 100 shares of a stock. You decide to buy another 100 shares of the stock down the road, and then another 100 shares down the road after that. So now all of a sudden the portfolio grows, and let's say it's too much or too big of a percentage of your overall money. So you're going to trim a position. You actually might have bought the initial 100 shares at a higher price than the last 100 shares, depending on how that stock traded. So you really need to look at your personal tax scenario and decide which part of that stock position needs to be sold to benefit you the most. Jay in Florida. I have money in REITs, real estate investment trust, with very good dividends. They are down over the last year, but the combination still of share price appreciation and dividends is still attractive. Now that interest rate cuts seem to be coming, should I wait it out and continue to collect the dividends? First off, REITs, whether they're traded or not traded REITs, you need to do your research. Just because something pays a high dividend doesn't mean it's a good investment. And unfortunately, I will say this, many REITs pay a decent dividend stream, usually more than 2%. So investors buy REITs because they pay this higher dividend, and they think they found the ultimate investment. What you want to look at is, what's the dividend it's paying, and what's the value going down or up of the actual investment. Add those two together. That gives you total return. So you might get a 5% dividend stream from your REIT, But if it's dropping 2% a year in value because the underlying investments are not that great, what is your real return? It's 3%. That's lousy. So I first look at and assess, is the investment sound? Does it have a good stable dividend? But does it have growth potential? Not just a high dividend to entice me to buy it for that dividend. You may have bought your REITs for exactly the wrong reason. Thomas in Fort Myers, Florida. Are Bitcoins a safe investment and for inflation protection? First off, I would not touch Bitcoin. I would not buy cryptocurrency. It is a speculation. It's like buying lotto tickets. It's like taking your $100 bills and throwing them into a fire. Bottom line, Bitcoin's a speculation. If you're going to speculate, plan on losing all of your money. Your second part of the question is cryptocurrency or Bitcoin an inflation hedge? No, it is not. Now, if you remember 4 or 5 years ago, the big selling feature from all the Wall Street firms and people peddling Bitcoin or cryptocurrency was it was a great inflation hedge. Well, guess what happened to Bitcoin over the last few years as inflation reared its ugly head? Cryptocurrencies and Bitcoin in general dropped 50, 60, 70% in value when inflation raged up over 9%. So clearly, not an inflation hedge. So those so-called experts who are not really experts but were trying to sell you Bitcoin so they can make more money, you lost a bunch of your money. Probably the best inflation hedge that we look at is really oil. Oil, in our opinion, is a great inflation hedge because it typically keeps up or exceeds the overall inflation index. But again, do your own research. I think many investors today need to realize that all investments are not created equal. Just because you hear a good sales pitch doesn't mean it's a good investment. If you get a lot of emails in your inbox about buy gold now or buy art or whatever it happens to be, make sure you read the fine print. Most of those emails are sales pitches. Most of them over-exaggerate what you can ultimately make on that investment. And most of those investments are ladled with all kinds of crazy cost structures, upfront fees, back-end fees, surrender penalties, non-liquidity. Most investments never belong in your portfolio, but unfortunately investors often buy investments because they sound good and the returns sound good, or they get free money and they latch onto this. Go to ReznyWealth.com, download any of our groundbreaking reports, click on that special reports tab, and as always, if you're not happy with the way your money's being managed, your client communication is lousy, your returns are lousy, call our firm for a consultation. We believe in real money management, and we are a fee-only fiduciary money manager 100% of the time. I'll be right back after this. I've just released a groundbreaking report, the 3 biggest risks you must avoid now. If you're a retiree, pre-retiree, have at least $500,000, this is a must-read report. I've covered the risks to your financial security and the facts you need to know to protect your hard-earned retirement savings. If you're at all questioning the advice you're receiving or your portfolio is lacking returns, go to ReznyWealth.com and download your free copy. I hope you're enjoying today's program, and as always, send your questions to Brian Rezny at ReznyWealth.com. You know, prior to really the overall market, really big increase in 23, we had a decrease in the market in 22. A lot of investors got nervous. A lot of investors may have sold investments. One of the things I want to stress to every one of you investors is this: markets go up, markets come down. Now, when I say markets, am I talking about the stock market? No. I'm talking about all markets. I'm talking about the bond market, the stock market, the real estate market, the oil market, the gold market. All investments do this. So think about this with your portfolio. If you do proper research, you buy investment assets that have a true growth potential of earnings, you have the best opportunity to grow the value of your portfolio. And remember, your portfolio doesn't go up each year or each month. What you're looking for is over the next 5 years that your portfolio goes up 5, 6, 7, 8 steps of stairs. Once in a while, it's going to come down a step or two. That's a normal recession. That's a market pullback. That's a short-term correction. Those are emotional points that usually trigger people to do the wrong things at the wrong time. Remember, you want to buy low and you want to sell high. William in Naples, Florida. I own shares of Boeing. Is there any hope for Boeing in the future, or should I just sell my shares? William, we do not own shares of Boeing. I would not touch Boeing right now. Boeing has really had poor management for a number of years. Granted, they're working on new management and making some changes. The amount of debt they've accrued over the last few years because of this mismanagement, because of the competition out there that has done ultimately a better job, Airbus. I would not own Boeing at this point. There may be a point in 5 years or 10 years that it may come back in vogue, but they've got a lot of work to do with management, with their product line, with their overall safety features of their plane. I think there's greener pastures for your money. I would sell the shares, take your tax loss, move on, and do better management next time, or do better research next time in order to buy companies that are well managed, that have earnings growth, which ultimately drive share price appreciation. Bonnie in Elva, Florida. What do you think about Treasury bills right now? Great question. So this is what I would say. Treasury bills are a bond, okay? There's all kinds of different bonds. There's Treasury bonds. There's short-term Treasury bonds, a year, 2 years. Long-term Treasury bonds, 30 years. There's all kinds of other bonds, corporate bonds, municipal bonds. What you want to do is don't just look at Treasuries. Look at all bond opportunities. What I would say is, with interest rates being where they're at, elevated, raised by the Fed, and with the economy slowing a little bit and inflation starting to abate, I think ultimately the Fed will start to reduce rates at some point. Not yet, but at some point. So if you're going to buy Treasuries, I would buy shorter term duration. I like floating rate type corporate bonds more than I like Treasuries right now. I think they have a little bit more safety feature from volatility of share price. Remember, when rates go up, bond values go down, and vice versa. So what I would say is stay short-term maturity until at some point we see the Fed reverse course and say, you know what, the economy's slowed enough, inflation's down enough, we want to keep employment stable, we're going to start slowly reducing rates. That would be the time you'd actually want to go intermediate to longer dated bonds in the portfolio. But right now, safety is key. Stay short-term duration, because that ultimately is your biggest risk. Pete in Bokeelia, Florida. My advisor is suggesting a structured product tied to the stock market. Is this a good option for me? No, it is not. Number one, Pete, your advisor is clearly working for some kind of brokerage firm, whether it's a big one or small one. Structured products are manufactured products by Wall Street. And they're manufactured for one reason. There's extra cost structure that the actual brokerage house receives by putting these structured products together. Structured products have lockup periods or surrender periods to get all of your money out. Never buy an investment that has a back-end surrender, a front-end commission, has a lockup period, or has high internal cost structure. All of those things, by the way, are involved in structured products. So if you're going to invest in the stock market, you're best just to invest in the stock market at a low cost structure and have liquidity anytime you decide you need to change that portfolio and sell or buy a different opportunity. Structured products do not give you that freedom. But structured products, again, are great for your advisor, because your advisor is clearly not a fee-only advisor, and you're not working with a fee-only firm. You're working with a firm that wants to sell you products that are better for their bottom line versus your money. And I think you ultimately need to understand that. You can go to ReznyWealth.com, by the way, click on our special reports tab, and learn a little bit more about what a real advisor is. We've got a free report, Real Advisor, Fake Advisor, right there at Rezny Wealth Management. It is free, it's educational, and ultimately it will protect your money from bad advice by knowing how to distinguish between a fee-only firm, a fee-based firm, commission firm, or a real fee-only fiduciary money manager. Sally in Naples, Florida. My husband recently passed away and I need a new advisor. He handled all the money, but the firms that I've interviewed so far have all been either commission, fee-based, and none of them have admitted to being a fee-only firm as you suggest. How do I find a fee-only firm? Sally, that's an excellent question. Again, go to my website, ReznyWealth.com. You're more than welcome to click on the consultation tab or call our office on Monday. We are a fee-only fiduciary money management firm. okay? And that is fully disclosed in our CRS, our ADV, and in writing. But we also have a free report you can download, which is Real Advisor, Fake Advisor. It'll give you a little bit more insight to protect your money when you're selecting one of these firms. The other big key, Sally, I want to recommend is when you do interview a firm or you're looking at any firm, you want to make sure you go to the SEC site and the FINRA site to make sure the firm and advisor have never had misdoings against clients like you. What is scary is when you go to the SEC site or the FINRA site and you check out these firms, you will find the vast majority, if not all of them, have been fined multiple times, hundreds of millions of dollars, if not billions of dollars, for misdoings against clients like you. And why is that? Because the vast majority, again, are not fee-only firms. They manufacture products. They sell these products which are not in the best interest of the client. They have proprietary product sales. They have revenue sharing incentives. All these things come against your hard-earned money. And again, you're in a situation where you can't rebuild that portfolio if you get bad advice. So what you need to do as an investor is hire a real firm to manage your money properly, and that always works in your legal best interest. Only hire a fee-only fiduciary money manager, and we'd be more than happy to help you. Again, call our office during the week or visit ReznyWealth.com. You know, one of the things I want to end with is really about the overall, again, U.S. economy and investing wisely. If you're a pre-retiree or retiree, your main stumbling block, of course, is getting proper advice, real advice. Your second big stumbling block is investing your money so that it can get a total return. And what does that mean, total return? It means you need income and you need to grow that portfolio over time. Remember, inflation is not going away. It may be coming down from the highs, but we're always going to have inflation. The average person that retires at age 65 that's married, one of you is going to live well into your 90s. That's a long-term retirement. So what you need to do ultimately is your money needs to grow and provide an increasing retirement income. So if you have a total return investment strategy, which is what we believe in, you're looking for income, dividend, income, growth. You're looking for the asset price to grow so you can over time grow the portfolio, grow your retirement income to combat inflation and its negative effect. Remember, $5,000 today is not going to be worth $5,000 5 or 10 years down the road. You need to do the right thing with your money. Honesty, integrity, compassion, and confidence, that's the difference Rezny Wealth Management provides all of our clients. If you're not happy with the advice you're receiving, if your returns are lackluster, if you're tired of bad client communication and service, call Rezny Wealth Management for a consultation. Visit our website at ReznyWealth.com. Let us help you secure your future and your family legacy. Have a safe and profitable day.